Hello everyone, welcome to the Mortgage Brothers Show interest rate update for Friday, April 22nd. Today we're going to go over interest rates, where they're at today, but we're also going to be looking at a couple things like how the U.S. debt has affected interest rates since really 1986 and what the interest rate history, like what the charts show from a big picture. So we'll get into that right away if you stick with me here. A quick disclaimer before we get going. The opinions expressed on this video are for informational purposes only. This is not financial advice. We are only licensed in the state of Arizona, and we can only specifically help borrowers get a mortgage to purchase a house or refinance in Arizona. But don't worry, no matter what state you live in, all these mortgage programs we're talking about, they're nationally originated. It isn't like there's a special Arizona mortgage. These are conventional FHA, VA loans that are available everywhere in the country. So, also, if you are new to this channel, you haven't subscribed yet, if you're in the market to be, of course, purchasing a house, looking for a mortgage or a refinance, or you're a real estate agent, this is a great channel to follow, subscribe, and comment below with any input that you have. So let's get right into it. The 30-year fix today we see at 5.125. We've seen that rise over since yesterday. Okay, so rates have just continued to rise. We see the Fed talking about more news. They call it hawkish. Their hawkish speech has basically pushed rates up even more. So 15-year fix at 4.375, a 5-year adjustable rate mortgage at 3.875, a 30-year fix FHA at 4.625, a 30-year fixed VA loan at 4.875, and here are the loan assumptions for conventional FHA and VA. And what we're going to look at today, just briefly, is what do these interest rates, at a 30-year fix at 5.125, what does that look like if you're purchasing a $500,000 house? How does it affect you if you're putting 3% down, 5%, 10%, all the way to 30%? You can see the breakdown. I've assumed taxes, homeowners insurance, just making an estimate, and you'll see the mortgage insurance. So if you have less than 20% down, you're going to have mortgage insurance, and you'll notice that that mortgage insurance goes down the more you put down. So we see at $3,100 there for 3% down, $3,000 for 5%, $2,800 and almost $50 for a 10% down. That's what those payments would look like. Here's what the estimated cash to close is across the board. And this also, we have another line here for the total interest over the term of the loan. All right, so today we're going to move on to, this chart. I've shown you this chart before, but we're going to just dive in a little bit different today. The 30-year fix, right? This chart is showing since 1971 that interest rates, really peaked in 1981. Everyone, a lot of you probably have heard, and a lot of you know that already, right? That rates were high in the early 80s. After the Carter era, the rates had absolutely, inflation had gone really, really high, but the 30-year fixed rate was 18.3%. I was alive, I was just a kid, but that was, I know a lot of folks, my grandparents were always talking about those days, but 18.3% for that 30-year fix right there. Now in 1986, we started noticing something different. We noticed that there was a channel. We call this a channel where if you just draw these parallel lines, you can just see it's kind of just stuck in this pipe, ricocheting off the top and bottom, the rates. Why are they going down and why are they stuck in this channel? Now they actually broke out about a month ago out of this channel. I don't think it will last very long. I basically put these little markers in just to show you where I'm thinking rates will go. And I don't know if that's going to be, towards the end of this year, 2023, 2024, but I do think rates are going to continue to go down over the long term. So what is causing this downward pressure? It's this. It's the U.S. total debt. And the debt, like if you really think about it this way, I wanted to show you this chart. This is from the Federal Reserve of St. Louis. you will notice that in 1986, that's where that channel started, the U.S. debt was about $2 billion. That's like, so $2 billion, today it's $30 trillion. And what was causing all of these? It was the money printing, the wars, the quantitative easing, the bailouts, the COVID stimulus, and it just continually led to printing the money. And the way we print money is, right, you'll hear the lawmakers, you'll hear the House and the Senate voting on packages. Oh, we need a war package. We need to stimulate the economy. We need to bail out banks. And what they do is they vote to have these big packages, these big funding packages. Then they approve these big funding packages. It goes into the economy, and basically our debt, the Federal Reserve is borrowing this money, right? Buying these bonds and increasing the debt. That's basically what's happening. Is they're putting the money into the market. But that's what's caused the rates. That's what's changed since 1986 is this type of spending on this debt. And right now, you will notice these gray bars are the recessions. And these recessions, this is the 1991 recession. Here's the dot-com recession. And you'll notice, now what you'll notice is that, there was some debt here that was increasing, but look at that debt it was increasing there. But look what happened in the big housing recession. This is the quantitative easing. All of a sudden our debt just spiraled, right? Just started cranking up. But you'll notice it just continued that same trajectory all the way to look where when COVID hit and then the recession, look at this. We almost went vertical, that spending overnight. I think it was that $3 trillion, stimulus for COVID. But anyway, here we are now. That's our debt. And when the U.S. economy has debt, think about it this way. They can tell them that they can, so on one hand, they have a lot of debt. That debt's expensive if interest rates are high, right? So it really is benefit. They basically are self-serving when they lower rates because they're lowering the interest on themselves, right? They could never afford, our government could never afford to pay this debt long term, all right? So that's why I do feel like we are going, let me go back to this. That's why I do feel like we are going to go, rates are going to come down. Now next week, if you follow me on this channel, you subscribe, I'm going to be showing you more details of why I believe what's going to cause us to go further down. I think there's talks of recession. How does the recession affect housing prices? Just stick with us on this channel, subscribe. We'll be back on Monday and hope everyone has a great day. Hey guys, thanks for listening to the Mortgage Brothers podcast. Please let us know if you have any questions you'd like us to answer. You can email your questions to team@azmortgagebrothers.com and be sure to ask us for a free quote on your next mortgage. We'll be sure to give you personalized service and help you through the whole process. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 and 1618695, Equal Housing Lender.